You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call around here the Options Insider Radio Network. 13 programs on the network, a baker's dozen, including well over 100 hours of archived volatility goodness in the Volatility Views program. Where can you find all of that? Well, of course, the flagship, the mothership, theoptionsinsider.com. Click on the Insider Radio Network tab, top left of the page there, and you're off to the races. All 13 programs available for you right there. Of course, you can also go to wherever you find your favorite podcast, iTunes, Stitcher, AHA Mobile, TuneIn, insert name of program here. We're probably on, and if we're not, let us know. We'll make sure we're up there. And if all that is too much of a hassle for you, just go to the iTunes store or to the Google Play App Store and just download our mobile app, available for pretty much iOS, Android, even the burgeoning Fire OS. You can, of course, get all of our shows there. Stream them, download them, fire off questions while you're listening, all sorts of fun stuff. No shortage of ways for you guys to get access to the programs, and then, of course, let us know what you think about them, because we love to hear from you guys. And joining me on the old program, first off, we have the major domo of all things derivative over there at BGC Partners, Mr. Jared Woodard. Jared, welcome to the program, sir.
Hey, I'm glad to be with you.
All right, and also joining us, we have a special treat this week. We have Double Trouble beaming in from the West Coast, the tag team of Mark Sebastian and Bill Luby, a infrequent guest, but he has been on before here on this program, and they're beaming in live from the CBOE Risk Management Conference out there in scenic and sunny California. Gentlemen, welcome to the program.
Good to be here, Mark. Jared, good to hear from you as usual, but it's fun to have the third partner in crime with us, Bill.
When the VIX is hopping, it's good to be part of the action.
Yep.
All right, guys. Well, like I said, glad to have you on board. So I think we'll do something a little bit different this show. Instead of diving right into the vol review, I want you guys, because you guys have been there all week, this is one of the first years I haven't had a chance to go out to RMC myself. So you guys can give us a little bit of a breakdown of what's cooking over there at RMC in our Volatility Viewpoint.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, welcome to the Volatility Viewpoint segment. This is where we invite on guests from throughout the world of volatility, proceed to pick their brains. Bill, you've actually been on this segment in the past. It's been quite a while, though. I'm trying to think the last time you've actually joined us on the program. So why don't you go ahead, before we even dive into what's cooking over there at RMC, why don't you go ahead and give our listeners a bit of an update on, everything you do over there, VIX and More, and all the other initiatives you have cooking over there.
Yeah, VIX and More has been a little bit backburnered lately. There are some cobwebs on it, but I plan on dusting those off and getting a little more active. I do write some columns for Barron's. I do send out a newsletter, and as of last year, I've started trading 2 volatility strategies under the RIA banner of Luby Asset Management, which I set up at the beginning of 2014. So that's all new stuff.
How'd you come up with such a clever name, Luby Asset Management? That's just profound.
It was going to be dynamic volatility, so if you want that, Earl, I can sell it to you for a small piece.
He was that guy on the floor of the SIBO whose badge was his initials. Very, very creative in that sense, very profound. Yeah. Exactly. Well, you guys have been out there all week in scenic and sunny California, basking in not just the sun, but also all things volatility out there. So maybe let's start there. I know whenever I go to RMC, I'm always confronted with some very interesting, thought-provoking presentations and thoughts. So maybe we'll start there. Maybe for each of you, what were the things that really interested you out there? Some presentations that really got you thinking about vol maybe in a different way.
Yeah, I think Bill and I collectively, there was 2 that we really liked. I'll talk about the Zachary one. Zachary one, and I'll let Bill talk about Buzz's speech. But Zachary Karabell, he's a historian and an economist, and he gave a really thought-provoking discussion. I think Jared would have been all over this thing on really the history of economic study, and he basically laid out that really we didn't start actively gathering economic data until the 1930s through the 1950s. So things like the unemployment rate and GNP, now GDP, really didn't exist until the Industrial Revolution had already started. And we're still trying to analyze what's going on in the economy with thoughts that are from the 1950s. And the Federal Reserve and economists, they're really trying to morph, but it's very difficult. So things like Google, things like intellectual property, or working on a startup that loses money. All right, that the economic activity that really pushes things around is not properly measured in what we're doing. And so when we say, his point was, so when we see something like rates, employment goes up, which means inflation goes up, which means rates goes up, that is not a very long piece of history that we're inferring all that, and interpolating all of that conclusion from. So it's entirely possible that the Industrial Revolution idea or the Industrial Age idea of employment goes up, wage growth, employment goes up, then inflation goes up, then rates go up, could be entirely not applicable anymore. And we could be in a scenario where employment goes up, inflation goes nowhere, and we have a rate curve where 30-day rates are almost the same as 10-year rates. And I thought that part of was really, it was an interesting speech. But then when he kind of got to that economic data, you have to really look at it with a grain of salt. That was really what was fascinating to me.
The other big aha is so much of the data was created in the 30s to the 50s. It's manufacturing centric, and it captures what was happening in this country up until maybe 30 years ago. But it really doesn't capture the types of economic growth and activity, innovation we've been seeing in the last decade or so, and misses out on a lot of that. Whether it's from output or labor or wages or whatever, it just fails to capture that slice adequately.
Yeah, what was the jobs report? He made a joke about it. He said, there is a jobs report that I pay attention to. It's called Apple's earnings, and I don't really pay that much attention to the jobs report that comes out every month. And I thought everybody thought that was hilarious, but he makes a point. Apple's earning all this money, so we're in a slow growth economy, and Apple's selling 60, 70 million phones. So there's a disconnect there.
That doesn't surprise me at all that, a lot of that, macro and microeconomic data is probably in a little bit different frame of reference these days. I always go back when I hear that kind of thing to when I was studying finance and economics in school, and they used to beat these concepts into our head that were at the time considered immutable, like the Phillips curve, that there was this guaranteed relationship between unemployment and inflation, and they would never waver and would always go along this line called the Phillips curve. And, all those relationships have in the past couple of decades have kind of just been blown out of the water. And now I think we're seeing a lot of that other data starting to, all these fundamental, I think maybe misconceptions we've had about the economy for so long are finally starting to be seen in a little bit clearer light. Jared, this must resonate with you quite a bit because you spend your days mired in that data.
Yeah, it does. It is. I've been really interested to read reports of this talk. I know this guy's written at length elsewhere on this subject, and it actually brings to mind a point that we made before on the show about something a little bit narrower focus and closer to some of our hearts, which is traders looking at the history of options, implied volatility to derive strategies and trade ideas. Things like the volatility exchange traded products and funds or implied vol indexes, things like that are afflicted by really the same problem, but even more so. Not only is the timeline of not just VIX, but the ETNs and the other VIX futures and other kind of data sources that people mine for strategies, not only are those timelines even shorter, but the composition of those markets has changed, really just year by year. And I was talking with the fund manager this week who was, keenly aware of this issue and trying to account for it in his approach. And, when you have the composition of the, the people who are active in those markets changing, the size of those players changing, the lack of transparency with regard to who's doing what, I think it makes volatility strategies even more challenging to develop and challenging to pursue with any kind of expected forward-looking basis, given the potential for really, really large changes. But yeah, absolutely. I mean, I think there's some economic data more broadly that does adjust for which industries are active and weight them in different ways. I mean, there are ways to deal with this problem. I mean, if GDP in the U.S. is driven by consumption, right? So the fact that we don't have a lot of manufacturing investment anymore, but rather service industries, it does raise challenges for comparisons versus data from decades and decades ago. On the other hand, we can construct indexes of what is happening currently in the service sector. There's ISM non-manufacturing indexes, for example. There are measures of consumption, and I think it's important to be aware of those problems, and then rather than throwing up our hands and sort of assuming it's all noise, try to do better. Try to do more work.
Well, so you hit on one study there. What else caught your eye out there at RMC this week?
Very interesting conversation, or I guess speech is probably the better word. Buzz Gregory of Goldman talked about global volatility. And I say global, but it really focused on the U.S. market and the Japanese market. And we take for granted and he talked a lot about skew. We take for granted the steepness of the skew in the United States. And he talked about how a lot of the skew around the globe has to do with culture, with traditional trades that are put on locally, whether they're structured or whether it's driven by the retail investment environment. And he talked, of course, in the U.S. how we have the long-only focus, and we put on a lot of SPX hedges. That's not news, but a classic Japanese trade are these auto-callable bonds, and I won't get into the details, but what they force to do is they force the dealers to hedge really heavily in the 2 to 5 year time frame. So what happens is you have a flattening of the skew traditionally, and depending on market moves, you can actually get frequent periods where because of dealer activity, weird things are happening in the skew, and a much less of a negative correlation, or sometimes a positive correlation between the underlying index, say the Nikkei 225 here, and volatility. So a lot of interesting conversation around how the local trade structures, if you will, drive the skew and the term structure of volatility. Interesting stuff.
Yeah, and one thing that I thought was fascinating was he made a really interesting argument that the liquidity of SPX options is part of what actually causes a skew, which you would think if you consider skew to be a mispricing or downside curvature, you would think more liquidity, more price discovery would actually reduce that steepness. They argue that because basically the liquidity in the S&P 500 comes directly from basically worldwide, all that liquidity actually increases the steepness of the skew curve. And then finally, and I'll let Bill talk about this, the difference between S&P 500 volatility and the volatility of, the average equity option that is in the S&P 500. There was, Buzz said something really fascinating about that, and I'll let Bill kind of get into that a little bit.
Yeah, if we want to do that now, I'll dive in. But long story short, the single stock volatility has been extremely depressed for the last year or so, more so than in any other time, I believe, in the lifetime of the VIX. While the VIX was relatively low, it was nowhere near as low as it has been in previous low volatility periods. And one of the comments from Buzz is a lot of this has to do with the exit from the markets of the banks have been providing certain types of trades that would arb this out and would basically make this disappear or lessen the impact of this type. But that dispersion type trade just doesn't exist anymore because the people aren't there to do it. So that opportunity is out there, and for anyone listening, that's something to think about to put in your business plan.
Yeah, that was interesting. I saw that come across your Twitter timeline there, Mark, about the S&P skew, and we retweeted it because it seemed like a very fascinating thing. And then one I'm glad you brought up because I was about to bring it up to you because it's one of those ones that on the surface that sounds contradictory. The fact that it's so broad and deep and liquid, it shouldn't have, you're right, that kind of discrepancy, I guess you can call it, in the skew, but it actually sounds like it actually exacerbates the situation.
Yeah, it attracts more. Foreigners find it easier and cheaper to come in and hedge in the U.S. equity market, which is reasonably correlated, I guess, for their purposes, than to try and do it in a less liquid local market. So they end up actually exacerbating the skew with the foreign demand for hedging in the U.S. market.
Let me ask you this. It seems like there's always at least one presentation at RMC, list all the times I've been there, where someone is trying to find some new angle on the classic VIX call versus straight up SPX put debate. And they try to find some crazy weird ratio, some strategy in VIX that makes it outperform versus the S&P put. I've seen people talking about VIX calendars versus S&P puts and put spreads and VIX ratios, all sorts of weird different studies. Has there been anything like that this year, and anyone come up with any strategies that made you either laugh or say, that's interesting?
It's been a lot of plain vanilla stuff. It's been a lot of covered calls and put rights and that sort of stuff. Really not a lot of exotic flavor yet now, and we're just about winding up here.
Yeah, I've actually been shocked. I mean, there's been less VIX discussion than, just a shocking lack of real in-depth VIX discussion while we've been here. The first presenter kind of discussed, from start to finish why the VIX exists. And we had some guys talk a little bit about variance. But really, it's been much more kind of put selling and SPX centric. And maybe this is part of their strategy because they're going into that extended hours trading. So, they're trying to get more guys to trade SPX in the off hours. So maybe that's why it's been much more SPX centric than the last few years.
Well, there were no new product announcements specifically here, but one of the things the CBO said that they're going to do this year is to roll out some new buy right indices. So it's quite possible that they've steered a lot of the dialogue here towards buy right and some of the research and some of the stuff that supports the indices that they'll be rolling out later in the year, weekly buy right, and some other, Russell buy rights and more international focus on the buy right. So it's possible that that's helped kind of rein in some of that more exotic thinking.
Yeah, and they talk a lot about RUT because Russell 2000, which had been cross-listed, is now only going to be traded on the CBOE. So.
They're not doing what was it, Amex or NYSE?
Yeah, Russell is dumping them, so
Really?
It's going to be entirely on the CBOE. That is a new part of the agreement. So all of those indexes. So there's going to be a cash settled EM, a big EM, cash settled big EFA, a cash settled VIX, a FTSE on the CBOE, and then the Russell 2000 is going to be exclusively on the CBOE as well. So. It's interesting, whereas across the street at the CME, they're trying to kind of get away from the floor. CBOE in the last couple of, at this conference, if anything, has made a move back toward pushing guys to want to be on the floor on that hybrid model. It's actually been a little surprising. The other piece that Ed had mentioned just in passing was that Bill and I were trying to figure out exactly what he meant, but they're going to take another stab at pushing VXST.
Really?
Without any details.
Without any details.
And we haven't had a chance to corner him and find out what he means by that. But I think it has potential. I think it was launched at the wrong time, and they're trying to figure out how to repackage it or maybe tweak with it. There might have been a sense of reconfiguring the calculations or whatever. But expect some, at a minimum, marketing efforts on that, and perhaps some actual, product innovation in that space as well.
That would be awesome, because we've talked about this, Bill, I'm not sure if you've heard our recent episodes, but the ongoing mystery that is VXST has been a frequent talking point for us. I had a chance to talk to Ed a couple of months ago back at their luncheon here in Chicago and asked him the same thing. I said, what is up essentially with VXXT? And he kind of gave me the same impression. Sounds like he gave you guys there, that he seems to be willing to tinker with it. I mean, he mentioned that it was launched in an unfavorable time, and it certainly was. People weren't really looking at a near-term vol product in the initial period. Realized vol was pretty low, so the use case wasn't apparent to a lot of people. But still, he seemed at least to me to be willing to perhaps adjust it. And sounds like you guys are getting the same impression. Because Bill, I'm not sure if you've been watching VXXT a lot, but there are some days, even days when SPX and VIX are doing robust volume, where VXST does zero contracts, zero. I mean, it's literally no traction.
I watch it closely. I love the product. I think it has a huge amount of potential, and I'm among the list of the people who are mystified by the fact that it didn't pick up. Of course, everything has a tipping point, and once it hits that tipping point, it can catch fire. But I think the SIBO sees VXST as a potential counter to VXX weeklies, and they'd love to have a product that could steal some of that action from the VXX weekly options. More my personal opinion.
Yeah, and actually, they're in a quote-unquote quiet period, so I don't think we can say the name of the company or anything. But there's a group here that's actually trying to push a ETF that is they're calling it a VIX. Our interpretation is it's more potentially a VXX without some of the carry problems, potentially. But that was actually, I think, aside from listening to Buzz and Mr. Carabell, that was what I kind of was most interested about at this conference. I didn't learn a lot, but I thought it was fascinating. Did you catch the blowouts, the blowout Hall of Fame discussion?
Yes, excellent.
It was a little long-winded, but hilarious.
I saw the tweet you put out about that with the trading cards. I thought those were pretty awesome.
It was awesome. I gotta see did you get a deck?
Yeah, Dean Carnott did an excellent job of comparing those who are famous for the various blow-ups in the financial markets with the McGuire, Sosa, Barry Bonds crowd, and drew a lot of parallels to the financial strategies on steroids, and it's just a matter of time before they blow up, and probably, they certainly won't be in the financial Hall of Fame, or Hall of Shame, or whoever they're putting it, but really good from the self-titled derivatives comedian, Dean Carnott.
Yeah, it was. It was interesting. And I hadn't thought about this, but all of these guys basically blew out on a carry trade. In a lot of ways, and you don't think about that, but everybody loves doing the carry trade, and apparently that's the one that puts everybody out of business.
Right. So we're, I guess, all potential Hall of Fame candidates here too.
I like that, the self-proclaimed derivatives comedian. I'll have to get him on the network then, because
that's very much a niche market.
That's a very specific brand of humor that I'm
zero inspiration.
that I'm kind of curious to hear myself.
Yeah, we hear he's expiring monthly.
A dated joke for all of you out there who were expiring monthly fans. But I'm a little saddened to hear that they didn't do some of the exotic VIX stuff that they have in the past at that conference, because that's one of the reasons I like to go to it. But on the flip side, it does make sense what you're saying, that they would kind of maybe reposition the focus a little bit on things like BXM and other possible iterations of those products, because let's face it, VIX is pretty much a success story. You don't really need to do much in the way of beating the drum for that. The other ones, BXM, and to a far lesser degree, put, like we talked about on this show, haven't really resonated, I don't think, to the degree that they want them to. So maybe giving this audience that's kind of coming in for VIX, you hook them with VIX, and then you give them a little bit of the old one too with put and BXM as well as maybe some Russell and other variants. That might be a way to hook them and maybe drive a little bit more traction for those products. So I can maybe see the CBOE mindset for why they would do that, even though I'd much rather go there and hear, here's this crazy esoteric VIX 1x3 versus S&P put, and this is why it blows the doors off hedging with an S&P put, and this is why you never thought of this before, and all these kind of other crazy things that you typically hear at an RMC kind of conference. Anything else really catch your guys' eyes that you really just kind of you liked or didn't like or surprised you out there before we wrap up here?
Not off the top of our heads. I think getting to talk to all these traders and meet a lot of people, getting to meet Bill in person 5 years after I founded a magazine with him was really fun.
Yeah, that surprised me. You guys had never met in person before. I've met Bill a bunch of times, and you've never met him once.
So, yeah, I've met Jared, I've met Bill. Jared's met Bill, and we've never actually all been in the same room at the same time together. So our goal is to fix that between now and next year's RMC. Maybe we'll all go to the one in Europe if and when they ever announce where and when that's going to be.
It's a sign of the times where you can start a business, shut down business, move on, and then 2 years later, meet the person you were actually in business with during that period.
Yeah, give me some economic statistics for that.
Yeah.
Yeah, that's not showing up on your annual labor report.
I like it. There you go. You guys busting myths over there and surprising a lot of people. Yeah, that surprised me too. You guys had never met before. So we're making a little class reunion here. A little expiring monthly reunion on the old Volatility Views show. Well, I'm glad you guys could beam in with us. We got a few more minutes. I want to make sure we get to hit on some of the highlights of the week that was from the volatility perspective. So without further ado, let's dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, that tune means it's time for the Volatility Review. This is, of course, a portion of the show where we dive into the week that was from a vol perspective. And, Mark and Bill, I know you guys have to run in a little bit, and I appreciate you guys taking the time out to join us here today live from the RMC Conference. So before you guys head out, why don't you each go ahead? I know you've been kind of busy, hobnobbing over there at the conference, but in between, if you had a chance to watch the VIX, watch the markets at all this week, why don't you give us some of your takeaways on the week that was from a vol perspective, what really caught your eye out there? Maybe, Bill, we'll start with you because it's been a while since you've been on the show.
It's been a pretty quiet week. I always pay attention, and lately I've kind of had a line in the sand at VIX of 15, and it's been, it seemed like once it crossed below that, it was going to stay below for a while. And very interesting to see that the Fed seems to have riled everyone up this morning and pushed the VIX up above 15, which I think is significant, at least for today. I'm sure people are going to wake up tomorrow and start to rethink some of that. But I thought it was actually a pretty quiet week, and relative vol and implied vol seems to be down. I was interested to see that the OVX, for those people that follow the Crude Oil Volatility Index, which was over 50 for 2.5 months or so, finally came under 50 this week. And people got a sense, I think, that oil has bottomed, or that it's at least going sideways rather than potentially, testing 30 or 35 again. So I thought that was interesting. All the commodities are moving today. The bonds are really moving today. So we suddenly got a lot of volatility everywhere. But I think it's more the market waking up and coming back to normal than being overly complacent.
And we joked about that on our option block program yesterday, that when the CEO of Exxon is talking up crude volatility, maybe we've hit a bottom. He's only like 6 months late to the party at this point.
Yeah.
And Mark, what caught your eye out there this week?
Yeah, I mean, the same thing. I think, it's interesting we had that discussion here with Zachary talking about inflation and things like that, right as basically this Fed stuff is what's causing market volatility. I spent a little time looking at what's gone on since the Fed started doing news conferences. And the news conference Fed meetings create a much bigger rally in VIX than regular FOMC. I think we're in a position where we could see volatility rally for maybe another week. I think we'll see the VIX maybe, even if the S&P doesn't just die, I think we could see kind of a less than bullish S&P and an extremely bullish VIX for the next week. And I would not be shocked if we saw VIX make a run at 18 or 19 leading up to that Fed meeting, and then she'll probably say the exact same thing, and VIX will plummet. Lost in this wage report today is that wages still will not go up.
Right. And people keep waiting for Janet Yellen to turn into a hawk. I don't know what they're waiting for, but eventually she'll have to move. But she's not going to become a hawk, even when she does move.
Speaking of Janet Yellen, I'm not sure if these guys told you, Bill, but Jared and Mark have an outstanding wager here on the show. Jared, I believe, was there will definitely be a Fed increase, a rate increase, of course, before the end of 2015. And then Mark said, no way. I think Jared even doubled down recently and said before June there will be an increase. So I'm curious, as one of their fellow former expiring monthly compatriots, where do you fall on the spectrum there? You agree with one or the other, or maybe you somewhere in between?
Well, I've definitely been in Mark's camp up until today. And I definitely think the market continues to underestimate just how dovish not only Yellen, but now the whole new Fed, since it's been reconstituted for 2015, really is. And the reluctance to move, and some people think they may have painted themselves into a corner, but so they get rid of the patience clause. But I still think they're not going to move before September, and it's possible they might not move to 2016. But the way everything's going across the globe, I just don't see the case for moving.
Yeah, I mean, and that's my point, is you've got all this QE, and look at where the dollar is. I mean, do you really need, with the dollar getting stronger and stronger and stronger, what motivation is there to raise interest rates? Either way, maybe we can have Bill join us for that steak, Jared, wherever that takes place.
Fantastic. Since you'll be footing the bill, I'm glad to invite Bill, anyone else involved. Yeah.
I asked if we could pick the location because I'd like to have one in Tokyo. We get some really good beef there.
There you go. Some nice Kobe beef there. Jared, are you standing firm on your revised double down on June, or are you maybe stepping back from that a little bit now?
Well, that was, to be clear, that was kind of a side second tier position I was talking about. I mean, I'm still firmly in the camp of an increase in 2015. I mean, I think that's I'd do that all day. As for whether it's June or September or December, there's some flexibility. I expect June. I think we get patience going next, and then look, it's absolutely the case that wage growth doesn't look at the kind of level that would demand 1 or 2% rates from the Fed right now. That absolutely. But I think we should keep in mind that their target for whatever you think the NARU, the naturally the rate of unemployment, natural rate of unemployment is supposed to be at a level in which the Fed has a neutral policy stance. We've hit that level of unemployment. Arguably, maybe that natural rate, whatever it is lower. But it's somewhere, we think, somewhere in this neighborhood. And if that's the case, then the Fed historically would be neutral here rather than maximally accommodative. When you combine that with the fact that wage growth in the highest beta areas of the economy, the sort of the hospitality and the leisure, the places that tend historically to rise first in a cycle, is just absolutely surging. In terms of average hourly earnings, there's a low print in that time series that's going to drop out in the next release for the employment cost index, which is going to look more like 3% coming up. There's a lot of stuff underneath the headline figures that suggests wage growth is much, much stronger than we might think. Walmart, TJ Maxx, these retailers that rely on lots and lots of cheap labor have already, they're telling us what's happening well in advance of any government data. They recognize that it costs somewhere between 15 to 20% of an employee's annual salary when they quit to rehire and retrain someone. And that's why Walmart and these other big retailers have started to increase wages, because they don't want to have to keep churning and rehiring as the market heats up. And I think that that's only going to continue. You've got skilled labor unemployment down, well below 3%. And every kind of point, every signal that I can see suggests that we're going to be looking at significantly higher wage growth in the back half of this year. And I think it's important to keep in mind that the Fed's goal is not to wait until wage growth is off to the races and then try to hike and tighten from there and play catch up and potentially overshoot and cause a recession needlessly. If they can gently raise once, wait a meeting or two, raise again, pursue something more steady and stable, I think their thinking is that gives them more flexibility if there are any bad shocks internationally. It also gives a kind of slower path, a gentler path, and that if you mentioned the Phillips curve at the top of the show, Mark, and there's a great paper on this. I think I mentioned it before on the show from the San Francisco Fed, arguing that the kind of pent-up wage deflation that we got during the recession actually bends the Phillips curve to make that unemployment and inflation relationship look really funny. And they go into some great detail on this. The Fed governors have been talking about this theory for quite a while, since really last August at least. It looks like the key people, Williams and Yellen and others, really buy into that view. And if that's right, then their thinking is that the kind of curve of wage, it's not a linear, slow growth scenario for wages, that once you work through all of that pent-up wage deflation, wages could actually turn out to rise very, very quickly from there. And so I don't think they want to wait until they see the whites of the eyes of inflation to start to move. And that's kind of the baseline reason why so many people on the street are looking for June or September of this year.
I love it. I just mentioned the Fed, and that just winds Jared up. It's fantastic. That's a great metaphor. I might steal that. The whites of the eyes of inflation. I may have to use that on a future show. But I know Bill and Mark, you guys probably have to run a little bit because the conference is kicking up again, I think, pretty soon. But before you go, really quick, maybe Mark, we'll start with you. What's coming down the pike over there in the pit that you want our listeners to be aware of?
Just read the blog every day and go to optionpit.com/blog and. If you're still interested in that creating income with options class we did, you can go to optionpit.com/income. But read the blog.
And Bill, I know you said you have a bunch of new ventures, including these new funds that you're managing. Where should our listeners go? They want to find out more and maybe pick you up as their volatility fund manager.
Yeah, well, everyone can always find me at VIX and More, which has a little cobwebs, but it will definitely start. You'll start seeing some action there, including some recap from the conference here. And you can contact me there for more information about Luby Asset Management and the volatility strategies I run.
Think you're going to start adding crude into the mix now that it's such an interesting product, and it has been for the past 5 or 6 months from a vol perspective?
I'm not equity centric, so in my volatility strategies, there's a lot of emphasis on crude and gold and treasuries and also global equity volatility as well, not just the VIX. So yes, a lot of action in crude and gold. So that's been a focus of mine for the last 6 months or so.
That's the and more part.
That must be the and more. I apologize for putting you just in the VIX bucket, sir. I had no idea you were so deep and broad.
Well, VIX was taken, so I had to add the and more and then figure it out later.
All right, guys, I appreciate you guys joining us. You can hop off if you need to run back off to the conference now. I think Jared and I can handle the rest of the show from here. And Bill, we'll have to get you on more often. It's fun to have you beaming in from hither and yon.
I'm always glad to be here, particularly when it's some sort of reunion.
There we go. All right, guys, good talking to you.
All right, great talking to you guys. Thanks.
And Mr. Jared, all that chatting about the Fed and everything else, we never even got a chance to get your take on the week that was from a vol perspective. So now the floor is yours, sir. Those guys are gone. Those hoodlums are off. Go ahead, take off, sir. What did you see this week that really caught your eye?
Yeah, you know what caught my eye was last week, looking at some of the soft economic data that we were getting for late January and in February. Some of the numbers were lower than people expected. Some managers were talking about deflationary risks. This seemed kind of crazy. And in view of all that crazy talk, we looked at a couple hedge ideas against the possibility of too much good news was the title of the note. And the thinking was just that higher frequency data, Treasury tax receipts, some other indicators we looked at were all very, very positive. And once you take out the seasonal effects, the weather effects, the underlying trends in these data series were very, very strong. And I think the jobs report today confirmed that. I think that the outlook is very, very bullish for the real economy in the U.S. That said, this is a situation in which there seems like there's pretty good odds that real gains in the economy may not show up in the prices of financial assets, that the gains may accrue to labor and to owners of businesses, and not necessarily to owners of financial assets, given the sort of makeup of the market right now. And so it makes sense to be pursuing hedges, not against dramatic downside tail risk or some kind of systemic crisis, but against worse than expected returns, against yield chasing that goes wrong or goes awry. And so this week, I think, kind of in terms of the economic data, and then in terms of the market reaction today, I think sort of confirmed that story. So with all that said, I think we might get much more of this, where positive data points get met with selling in the market and with shifts into assets that aren't going to be as sensitive to the turn in the rate cycle and the turn in the labor market, which is a little bit counterintuitive compared with the behavior that we're used to from the last 5 years or so, where every news point is some kind of deflationary risk or tail risk situation. So it is a little bit more unusual way to think, but obviously lots of opportunities still to pursue interesting hedges and interesting structures to get positive carry without lots and lots of downside risk. And it's because of all that potential, I think, that I and a lot of other people have a higher average vol target for this year, after some quiet time in the VIX this week, I think got us right back on track.
That carry trade, getting that carry profit without, of course, joining that deck of 52 greatest blowout trades of all time, or whatever they were showing off over there at RMC this week. I'm not sure if you saw that tweet, but it looked pretty funny. This deck of, they had had a bunch of guys on there, from all the names you could think of in recent history. Pretty funny stuff. I mentioned before, I was kind of joking about the Exxon CEO kind of talking up vol this week, but he certainly did that. He said you should expect more vol going forward in the crude product, which of course we all know is very late to the party here. But I'm curious, what's your take on that? When the Exxon CEO comments on something like that, maybe that is some sort of signaling of a paradigm shift in the marketplace, and maybe we are hitting a turn. And B, what'd you see out there in crude that really caught your eye this week from a vol perspective?
Yeah, I think you're right, and CEOs are very, very good at picking out different things from the news cycle to justify or to explain otherwise incongruous earnings results, if that's on the table, or other kinds of news. I think that's a job requirement.
Well, we joked last episode, of course, about the SIBO blaming the VIX term structure. I mean, they get pretty esoteric, the excuses they're throwing out there these days.
Right. So, but I think Bill or Mark said earlier, on a price basis, crude seems to have found some stability here. And while I don't know of anyone who's got an economic case for why crude would get back to $100 a barrel this year, there's certainly no reason why, if demand in the U.S. picks up, if gradual supply reductions in the north part of the country and in Canada start to take shape, that crude might not move a little bit higher. One manager I talked to this week is looking for another major down leg, and I think the options market now has become a little bit more amenable to someone who wants to position that way. But that's not really my view. And in fact, if you see more stability, more potential for price stability in crude, I think there may be still some good, interesting sales out there in options land.
Yeah, there certainly are some still attractive levels. You got to be a little bit more, perhaps, judicious. You can't just go out blasting away at bids and get the same levels you could very recently. But still, you're right. There are some opportunities for the judicious premium seller out there. And before we move out of the vol review, Jared, I know you like to look not just domestically but also internationally. What's cooking on the international vol front? Anything really catch your eye out there over the past week?
Yeah, I mean, I think the big news was the ECB yesterday on Thursday. More details about their plans to purchase sovereign debt. VSTOXX, the VIX equivalent there in Europe, has come in pretty sharply and is trading comparably to the VIX curve in terms of where those volatility futures are priced. A lot of folks ended last year with no optimistic scenario, no even cyclical kind of rebound for European equities. I wasn't really looking for that, but that's what we're getting. And some of these growth figures, not just in Germany, but in some of the periphery, are are really positive. And you combine that with the efforts of the ECB, I think you've got a very, very positive situation for the medium term. This isn't a structural fix. It's not going to turn things around, but the risk premium certainly has come out of V stocks.
Yeah, I wouldn't mind seeing V stocks get a little bit more traction here in the States. I know, like you said, it does well, over there in Europe. Of course, VIX is the dominant player here in the States. I wouldn't mind seeing a little bit more interaction, and get a little bit more volume from, and a lot of more people here just trading it. You don't hear, particularly on the retail side of the fence at all, any retail people are going out there and quoting V stocks, talking about it. And yet I think it would be a surprising product for a lot of them. I think Mark was talking about maybe they might add it on the SIBO someday on the floor there. I said that kind of would surprise me, given how much it tends to encroach on VIX territory. But still, it's an interesting product that I wouldn't mind seeing it get a little bit more traction in the marketplace, just so we have more options, pun intended, from a volatility perspective. Speaking of vol options, let's do a quick rundown here of what we saw out there in VIX land this week. Like I said, it was a fairly light week yet again from an overall volume perspective, although open interest ticking up a little bit yet again. We're close to hovering right around 5 million contracts. So getting close, getting back closer, I should say, to that average open interest that they've been hovering around, which is a little bit north of 5 million these days. So they're getting right around there again, which is, for a while there after expiration, those numbers were extremely, extremely low. And talking about the hot trades, the hot strikes that people were lighting up this week over there in VIX land, number one was the March 20s, yet again with 170,000 contracts open, so a little bit higher numbers this week to talk about. And right on the heels of that, the March 23s with about 167,000 open. Then the March 16 puts, so the puts have dropped to the numbers 3 spot on the top 10 there with about 162,000 open, followed by the March 14 half puts with 143,000 contracts open. Number 5 spot are the March 30 calls, the ever optimistic March 30s, holding into the number 5 spot with 127,000 contracts open, followed by the March 18s with 124,000. The March 15 puts back to the put side, to the dark side with 117,000 contracts. Number 8 and number 9 pretty much equidistant, about 116,000 each for the May 20s and the March 27s. And rounding out the top 10, we have the March 16 calls for a whopping 111,000 contracts open. So still pretty call heavy, but though puts are still up there in force, and predominantly March with a wee bit of May thrown in there for some flavor. And of course, VIX extended hours options started again this past Monday. We're going to see SPX extended hours kicking in next Monday, the 9th, of course, the day you guys are actually listening to this. It'll be interesting to see how those numbers. So far this week, the extended hours didn't really seem to add anything to the overall whole. We'll see how the extended hours work for SPX going forward. Speaking of going forward, we're going to go forward into our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, you guys know the drill by now. This is the portion of the show where we prognosticate recklessly, indeed wildly, the future of volatility. We are, of course, recording this on Friday, March 6th, and it's actually a day when the markets are selling off fairly aggressively. Most of the major indices down a little over 1% on the day. The Dow actually down 1.5%. So VIX ticking it up a notch a bit today. VIX Cash hovering a little bit south of the 16 handle. And if you've been listening to recent shows, we were talking about whether we'd break the 12 handle anytime soon. So we're getting a little bit of a boost to vol today. Mr. Jared, given the environment we're in today, what are you thinking for the week to come? You thinking we're going to have a little bit more? Sounds like you're leaning on more vol creeping in these days.
Yeah, I at some point, I think folks who are pricing assets for deflation risk are going to give up on that approach, are going to stop trying to squeeze yield out of things that just don't have it, trying to get blood from a stone, and position for the alternative. There's been a lot of really good journalism in the last month or so. One piece was committed by me that I don't know was good or not, but a lot of coverage anyway of the composition of a lot of the fixed income products that have become very popular, especially the ETFs, like HYG, JNK is another one. In high yield space, but across the board, even in the AGG, another fixed income ETF, and the fact that agency mortgage-backed securities, other components of these indexes have become fairly hard to find, and and the corporate bonds that are held in some of these ETFs aren't very liquid. And so there's a lot of worry that when managers do need to reposition in a big way, there aren't going to be enough. There's not going to be enough liquidity in the underlying instruments to make the ETFs, to make the markets clear in a straightforward way. And this could happen kind of at any time. It could happen around a Fed meeting, or it could happen on a day when some very large asset manager decides it's time to change the composition of their portfolio. And there's a premium in the options on HYG associated with that liquidity. Some folks that I respect have argued that premium's high enough to be something worth collecting, at least for the near term. I'm not sure if I agree or not, but I think it's a really interesting question. I think that there's things like this in the market that have to do with, again, not systemic risks or tail risks, but with market structure, with investor positioning, with what the overall outlook for the market is on what the risks are for the bulk of this year. And as I say, I think that these could come to fruition any time, and investors might not wait for obvious key events to reposition themselves. So that's why I think that it's smart to put on tactical hedges, not just ahead of key events, and not necessarily in a systematic, constant way either, but in such a way that you can target areas of concern in your portfolio. And I think that next week, with the jobs data out of the way, with people looking ahead to the next Fed meeting, is one of those weeks where there's no reason to expect anything dramatic to happen. But at the same time, some of the risks that we've been talking about could easily start to come to bear, especially as economic data is improving. We get out of the winter months and people start thinking towards spring and pastels and love and all those things.
I like your version of spring, sir. Spoken like a true philosophy major at the end of the day. I like it. All right, that's about all the time we have for the show today. Mr. Woodard, glad you can join us. And before you go, as always, give us a sneak peek at what's coming down the pike over there in the land of BGC research.
Okay. Well, one thing I've been messing around with lately is trying to actually tackle one of the issues that we were talking about at the top of the show. The fact that the economic data with which we're all familiar is driven by historical changes that aren't maybe clear in a time series. It's driven by attempts to adjust things seasonally. And so a lot of times we look at headline figures and they seem to say one thing, but if you take a different approach to seasonal adjustment, for example, you might come up with a very different conclusion. And so that's one thing I've been working on. It's a little bit more on the nuts and bolts side of things, but looking at different methods for adjusting seasonal factors in an economic data series, and had some success there. Put on a note actually this week, looking at Treasury tax receipts and different ways of adjusting seasonally for those. So I think it's a really promising area. It gives you much different takes sometimes on what the underlying trend might be. And so I plan on using that in some interesting ways over the next several weeks with regards to choosing and selecting option structures.
Since we're talking about updating old school economic data, we talked about the Phillips curve a few times on the show. I'm just curious, where do you fall on that lingering economic debate? Are you one of those who kind of adheres to the old school belief that there is this clear linear relationship between unemployment and inflation, or do you feel that it's been blown out of the water in recent decades and that relationship is much more complex than that curve would lead us to believe?
I guess I lean in the latter direction. That paper I mentioned earlier is a kind of a case in point. You can look at just the mere fact that employers tend to, in a recessionary environment, lay off employees rather than pay them reduced wages. The fact that so you go from your normal salary down to zero rather than a kind of a smooth distribution means that wages kind of get stuck at nominally higher levels than they would otherwise. And that when you get into an economic recovery, those wages, in the minds of everyone in the economy are still at those artificially higher levels. That creates a kind of what the paper and the Fed governors call pent-up wage deflation. We have to work through that pent-up wage deflation in order to get real growth in wages and real movement in inflation. And that's not a linear kind of situation at all. And so accounting for that is tricky, but if you believe in anything like that, and I think that story is pretty intuitive myself, it means that analyzing the relationship between employment and wages and inflation is a much more difficult situation, much more the realm of curves and calculus rather than linear algebra.
Yes, they don't call it the dismal science for nothing, sir. Unfortunately, that's all the time. I wish we could sit here and debate economics for quite a while, but the show has come to a close. And on behalf of Jared and Mark and Bill, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great questions. Didn't have time to get to them today. Don't worry, we'll get to more of them next week. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.